This PPT has been prepared by referring many sources from the internet that includes notes, diagrams, videos, textbooks. This is exclusively used for the purpose of education. Welcome to third part of module 5. In this part we will discuss about what is depreciation, how to calculate depreciation, what are the importance of depreciation, how it affects the entire process of an industry. Let us discuss about the definition of depreciation. It represents the reduction in market value of an asset due to age, wear and tear, and obsolescence. Normally, when we purchase a brand new bike, it costs some X. Even after one day, if I want to sell it, I will not get the same value as X. It would have lost some value from it. That is called as depreciation. Even if I keep it as it is, even without using it for 1 month or 6 months, if I want to sell it, it becomes a second hand vehicle. It won't fetch the same value what I had paid for it, even if I have not used it. So that is the meaning of depreciation. Every asset lose its value over the period of time. That is maybe due to age or due to wear and tear or due to obsolescence. Obsolescence in the sense the technology of what I had yesterday may not be useful today. See, for example, scooters, hand operated geared vehicles like Bajaj Chetak. At one point of time, it was a pride to have Bajaj Chetak scooters. The gear was to be operated using hand. Later, bikes were brought into the market wherein the operation of gear is using leg, which is very comfortable. Now, who will use that hand operated geared vehicles? Nobody. Even if I release it to the market, nobody will be eager to purchase such kind of vehicle because they have already seen the difficulties of that. The technology has changed. That old technology has become obsolete. I cannot carry on with the same technology. I need to update the technology and come up with newer and newer product. The physical deterioration of the asset occurs due to wear and tear with the passage of time. I keep on using the bike. I keep on using the chair. I have paid 750 rupees for a brand new chair. After 3 months, if I want to sell it, can I get 750? No. Because of wear and tear, usage, it would have lost its value. Physical deterioration, that is termed as physical deterioration. Depreciation amount for an asset is usually calculated on yearly basis. What is the total depreciation per year? That is how the depreciation amount for an asset is calculated. Depreciation is considered as expenditure in the cash flow of the asset, although there is no physical cash flow. Actually, the cash flow is not physical, but the value is lost as we use it. So it loses its value and it fetches us lesser amount even though there is no physical cash outflow. Why it is important? Depreciation plays a very vital role while calculating the income tax. See, the purpose of depreciation is to consider for two reasons. First reason is about to provide the recovery of capital that has been invested in physical property. I have invested 10,000 rupees on a particular asset. After 1 year, when I declare the value of that asset, I cannot declare 10,000 again because of the depreciation. It has already lost its value. Now, what is the exact worth of that asset now? It is not 10,000. So when it is not 10,000, the total assets worth will be reduced. So as a result, what will happen? The income tax also gets reduced. That is the advantage of depreciation. To enable the cost of depreciation to be charged to the cost of producing products or services that result from the use of the property. So that is another advantage of depreciation. It enables the cost of depreciation to be charged to the cost of producing the products. I can charge that. I can charge it to the cost of producing the products or the providing services. So while using that property or the asset, I will be producing product, and whatever the depreciation amount it has obtained or amount it has lost in it, that can be used for my balance sheet. Depreciation cost is deductible in computing profits on which income taxes are paid. That is another advantage. While calculating the profit, I will reduce the amount depreciation amount from the total profit, so that my total income tax gets reduced. Causes of depreciation. What are the different causes of depreciation? There are many causes. First one is physical depreciation. What is physical depreciation? Any asset will gradually break down over a certain usage period as parts wear out and need to be replaced. Eventually, the asset can no longer be repaired and must be disposed of. It is physical depreciation. I have to scrap it. It cannot be used anymore further. So it cannot be either replaced also. It has to be scrapped. So the parts are not available. We purchase a bike, we run it for 20 years, after which some parts, if I want to replace some parts of that particular vehicle, if I go to the market, the showroom people will say, oh, this is a very old model, you cannot get the spare part of that. Then what I have to do? I have to scrap it. So that is physical depreciation. This cost is most common for production equipment, which typically has a manufacturer's recommended lifespan that is based on a certain number of units produced. Once you have produced that many units, the manufacturer will say you cannot use it anymore. Even vehicles, see for example trucks, buses, normally manufacturer will say it can be used for 15 years, after which it has to be scrapped, or else you have to take a fitness certificate. That is the government now. Any vehicle which is older than 15 years has to be obtained a fitness certificate. So unless or otherwise you have a fitness certificate, you cannot run the vehicle on road. So RTO will give that fitness certificate stating that this is absolutely normal, the emission is under control, the vehicle is also physically strong enough to serve its purpose, so we can use the vehicle. So this is another point that we need to note during depreciation. Second one is functional depreciation. What is that? The performance of an equipment may continuously decrease with time, unable to meet the demand. In other words, demands made on an asset may increase beyond its capacity to produce. At the other extreme, the demand for services may cease to exist. Many times it so happens that especially these trucks, the actual capacity would be say 10 tons. They will be running at 15 tons in order to gain more profit. As a result, what will happen? It meets the end early. It also gets trained. Machine also gets trained. That's what we need to understand. It's not that only we feel this strain, we feel fatigue. No, machines will also feel fatigue. That's what we need to understand. So as a result, what will happen? The functional ability of an asset or an equipment may continuously decrease with time because of the over usage of that particular machine. Next one is a technological depreciation. As and when the technology changes and new machines with newer technology come into the market, they may produce products at a better quality with better tolerance range. So the older machines may not be sufficient to meet the customer's demand, especially these punching machines. If I have a very old punching machine, the tolerance limits which it meets may not be satisfiable to the customer, then I may have to replace that punching machine. So when that is the case, the value of that particular asset gets reduced, and due to technology also, the assets go on losing their values. Next reason is about sudden failure. What may happen? Um, what we term it as the catastrophic failure. The value of the asset may become almost zero or negligible due to inherent technological flaws. But it doesn't include loss due to accidents or misuse. Sudden failure may happen. See, technologically, it could have some flaw which was not identified earlier, and I was using that, and all of a sudden it stopped working. Why it stopped working? There was a flaw which I could not identify, right? uh, just like cardiac arrest, heart was functioning absolutely perfectly without any problem, and all of a sudden cardiac arrest happened and the body is dead. That is termed as a sudden failure. That's termed as a catastrophic loss or catastrophic failure. But accidents and misuse are not a part of this sudden failure. It is due to exclusively due to technological flaws. So some of the parts may be loosened up, and it was there right from the beginning, and the material that they have used is not to the required level or what they had promised. I did not notice that they had used a faulty material without testing it. So I continue to use with it, and all of a sudden the gears broke out, and the equipment stopped working. That may happen. Abnormal occurrences, this refers to the accidents, okay. And as I said, the trucks with a capacity of 10 tons will be made to carry 15, 18, sometimes even 20 tons. And what will happen to the axle will break. That is absolutely due to misuse, and excessive wear and tear will occur, improper maintenance, and it's human made error, and abnormal occurrence happened and the axle broke down. And what will happen to the value of such trucks? It will lose its value. And once you come across any accident to a particular machine, that machine's value is lost. So that is another reason for any machine or any asset to lose its value. Next one is depletion. Depletion is not exactly the depreciation. Depletion is the reduction in the uh, actual resource itself. See, for example, uh, natural resources like petroleum, it is depleting day by day. Rivers, they are depleting day by day. Many of the rivers have died down. We had Saraswati river at one point of time. Due to continuous drought, it has become extinct, and we do not know where that Saraswati river was. Even though scientists, engineers, they are trying to identify the route, it's very difficult to locate. But in our many mythological stories, we narrate the story of Saraswati, right? And unfortunately, that Saraswati river itself is not there. Rivers become extinct, deplete, ponds gets deplete, water source gets deplete, petroleum source gets deplete, iron ores, gold ores at KGF. So for example, at KGF, gold was abundantly available 100 years ago. Now scarcely any gold is available there. It has depleted. So that is also termed as depreciation. Depreciation in the sense loss of value. Okay, so depletion is also one of the reason. So these are the different reasons for depreciation. Now let us switch over to basic methods of computing depreciation charges. Predominantly there are four methods. First one is straight line depreciation method, second one is declining balance, fourth one is sum of years digit method, and then sinking fund method. First let us start with straight line method. What is straight line method? The straight line depreciation is probably the simplest and most widely used method of computing depreciation. It assumes that an asset's cost should be assigned equally to all periods benefited. Uh, how it is calculated? The formula is very simple. Depreciation is given by initial cost minus the salvage value divided by the service life. If the initial cost of an asset is say 10,000 and the salvage value is 1,000, then the service life is 5 years. Then depreciation per year is given by 10,000 minus 1,000 divided by 5. So that is the simplest way of calculating the depreciation per. Next method is a diminishing balance method or declining balance method or fixed percentage method. Three different terminologies are used. Here the assumption is that depreciation per year is maximum at the beginning and goes on reducing as we pass by. In the sense, it is calculated based on a fixed percentage of the value of the asset at the end of each year. So the value of the asset will be maximum at the beginning and the value of the asset goes on reducing, and as a result the depreciation value also goes on reducing. So this is the major way in which diminishing balance method is calculated. In straight line method it was uniform throughout, whether it is for the first year or the second year or the third year. Every year the depreciation charge was uniform in straight line method, whereas in diminishing balance method or declining balance method, as the name itself suggests, it is calculated as a fixed percentage of the total value of the asset that it has every year. So that is how it is calculated. It provides depreciation by means of periodic charges, and the formula is given by 1 minus SV divided by P whole raised to 1 by 1, where SV is the salvage value, P is the initial amount, and N is the number of years or the life of the. Sum of the years digit method. The third method is termed as sum of the years and also called as SYD or SOYD, and which provides for a proportionately high depreciation expenses in the early years of an asset's life. How is it calculated? It is calculated by using the formula n minus m plus 1 divided by SOY multiplied by P minus SV. Depreciation rate dm for any year m is given by this much, this formula. N is the actual life of the asset, m is the year at which I want to calculate the depreciation, SOY is the sum of the years, that is sigma n, multiplied by P initial value minus SV salvage value. The numerator of the fractions are the individual years in the estimated useful life of the asset, whereas denominator is the summation of all the years. That is why it is called as sum of the years. That is nothing but sigma n, where n is the total life of the asset. Last method is a sinking fund method. In this method it is assumed that the money is deposited in a sinking fund over the useful life that will enable to replace the asset at the end of its useful life. Okay, how it is done? Normally in this case what happens, the depreciation amount goes on increasing as we move further, because it is assumed that the depreciation fund earns an interest, and I am not able to earn that interest because of the depreciation. The asset lost its value by some amount, and at the same time I also lost the interest that I could have gained over that particular asset. That is why it in this method that interest rate is charged on the depreciation fund. As a result, the depreciation value goes on increasing as we move further. It is given by p minus sv multiplied by a by f comma I comma n, or that is nothing but I divided by 1 plus I to the power of n minus 1, where I is the interest rate and n is the total number of years. Next year's depreciation is obtained by multiplying the previous year's depreciation by 1 by I. So if this year's depreciation is say 2000 rupees, next year it will increase by and 1 plus I. If I is 5%, then I have to multiply next year's depreciation by 1.05. That is how it is calculated. Let us get on to numericals now. First we shall have a simple problem. The initial cost of a piece of construction equipment is 35 lakhs. It has a useful life of 10 years. The estimated salvage value at the end of its life is 5 lakhs. Calculate the annual depreciation and the book value at the end of 7 years of the construction equipment using straight line method and sum of years digit method. Okay, these are the two methods I have to employ here. Let us start with the straight line method. The initial cost is given as 35 lakhs. Estimated salvage value is 5 lakhs. Useful life is 10 years. Straight line method, the formula is given as initial cost minus salvage value divided by service life, and when I substitute the values 35 lakhs minus 5 lakhs divided by 10, I get it as 3 lakhs per year. So using straight line method I can very easily calculate the depreciation amount is rupees 3 lakhs per year, and it is constant throughout. First year also 3 lakhs, second year also 3 lakhs, third year also 3 lakhs. So this is the total amount of depreciation per year. If I want to calculate the total amount of depreciation at the end of third year, simply what I have to do, 3 lakhs multiplied by 3. So 9 lakhs is the total depreciated amount at the end of third year. So what is the value remaining in the asset at the end of third year? If I want to calculate, total depreciation amount is 3 lakh into 3, 9 lakh rupee. So what is the value remaining in the asset? 35 lakhs minus 9 lakh rupee. That is 26 lakhs. So 26 lakhs is the total amount remaining in the asset at the end of third year. So it is a very simple method, not very robust. Okay, so the total depreciation charge at the end of 7 years is simply calculated as 3 lakh into 7, 21 lakhs. The book value at the end of 7 years is 35 lakhs minus 21 lakhs, that is equal to 14 lakh rupees. Now the depreciation using SOYD method. SOYD method is given by dm is equal to n minus m plus 1 divided by sum of the years multiplied by p minus sv. For the first year, let us calculate it for the first year. How do I calculate? N. What is the total number of years? 10. At which year I want to calculate? First year. So m will be 1. N will be 10 plus 1. Whole thing divided by SOY. That is sigma n. Sigma 10 it is. So if I add that, I will get it as 55 multiplied by P. What is the initial amount? 35 lakhs minus salvage value. What is that? 5 lakh rupees. So if I calculate, I will get it as 545,454.55. That is depreciation for the first year. So what is the book value at the end of first year? Book value is the value remaining in the asset after deducting the depreciation amount. So what is the depreciation amount? 5,45,454 rupees. So what is the book value? 35 lakh minus 545,454 minus 0.55, that is equal to 295,4545.45. That is the book value remaining of the asset remaining at the end of first year. Depreciation for the second year. What is the depreciation for the second year? dm is equal to n will remain as 10, m will become 2 now because it is being calculated for the second year, plus 1 divided by 55, that will also remain as same as the earlier one. Multiplied by 35 lakh minus 5 lakh, that will also remain as it is. So it comes out to be 490909. What is the book value at the end of second year? Value at the end of first year minus depreciation during the second year. How is that calculated? What was the value at the end of first year? 2954545. What is the depreciation during second year? 490909. Subtract second year's depreciation from value of the asset at the end of first year. You will get the book value at the end of second year. Now let me tabulate that here very clearly. See here, we can very easily note down here. Value remaining in the of the asset at the beginning is 35 lakh. First year's depreciation this much. So this column minus this value, you will get the book value at the end of first year. Book value at the end of first year minus this value, you will get the book value at the end of second year. Book value at the end of second year minus depreciation at the during third year, you will get book value at the end of third year. Book value at the end of third year minus depreciation during fourth year, you will get book value at the end of fourth year. If you calculate like that, this is what you need to get. What is the book value at the end of 10th year? Book value at the end of 10th year is nothing but the salvage value. And this is the cross check. If you do not get the salvage value at the end of 10th year, we have gone wrong somewhere and you need to recalculate everything. You have to, this is a cross check for you. If this answer is not the salvage value, there could be some 50 or 100 rupees plus or minus could be there because of the decimal places. That is acceptable. But if the value comes out to be too much of difference, then there is some wrong mistake in the calculation. You have to recalculate. So I can answer any question now. What is the book value at the end of 7th year? 8,27,272 rupees. What is the total depreciation fund till 7th year? Add all these. If you add all these values, that will be the depreciation fund at the end of 7th year. What is the book value at the end of third year? This is 20 lakhs 272.73. What is the total depreciation fund till third year? Add up to third year. So this, once you prepare this table, you can answer any question that is asked in the question. So this is very, very important. Let us go to second problem. A machine costs 1 lakh rupees and has a scrap value of 4,000 at the end of 4 years. Using the reducing balance method, calculate the depreciation and book value at the end of each year, depreciation fund at the end of third year, and if the rate of interest on depreciation fund is 4%, calculate the book value at the end of third year using sinking fund method. See here, same problem, two different methods. In the previous problem was same, but we solved the same problem using two different methods. One was the straight line method and the second one was SOYD method, sum of the years digit method. In this problem, we will solve another two different methods. One is declining balance method or reducing balance method, and the second one is sinking fund method. First, let us start with the reducing balance method. In reducing balance method is also termed as fixed percentage method. First, we have to calculate what is the fixed percentage. What is the fixed percentage? It is given by dm is equal to 1 minus SV divided by P whole thing raised to 1 divided by N, where N is the total number of years. I know SV, what is the salvage value? 4,000 rupees. What is the initial amount? 1 lakh rupee. What is the total number of years? 4 years. Substitute the values, you will get the answer. Fixed percentage is 55.2%. Right? Now, every year the value of the asset goes on reducing by 52%, 55.2%, I mean to say. Next, we will calculate the depreciation book value at the end of each year. So in this, we can see that the value of the asset at the end of beginning year is 1 lakh rupee. So depreciation amount during first year is 55.2% of 1 lakh rupee. And the book value at the end of the first year is book value at the beginning minus depreciation amount during that year. So depreciation amount during first year is 55,200. Book value at the beginning was 1 lakh rupee. So 1 lakh rupee minus 55,200 is the book value at the end of first year. So book value at the end of first year gets transferred to book value at the beginning of second year, same amount. So what will be the depreciation during second year? 55.2% of the book value at the beginning of second year, that is 44,800. So that comes out to be 24,729. So what is the book value at the end of second year? 44,800 minus 24,729. So remaining value is 20,070.4 rupees. So that will be the book value at the beginning of third year. So what will be the depreciation amount during third year? That is 55.2% of 20,070. So that comes out to be 11,078.8. So what is the book value at the end of third year? That is book value at the beginning of third year minus depreciation amount during the third year. That comes out to be 8991.5. So that will be the amount at the beginning of fourth year. Depreciation amount during fourth year is 55.2% of 8991. That comes out to be 4963. And when you when you complete the calculation, you should arrive at the salvage value. What is that salvage value? It was around it was 4,000 rupees. Now I have got the value of 4,028 because of the decimal places. Since everywhere I have calculated only one decimal point, so that much of difference is acceptable. So and hence the depreciation fund at the end of third year is, what is that? What is the depreciation fund during the first year? 55,200 plus depreciation fund during second year 24729.6 plus depreciation fund during third year 11078. When you add these three things, you will get the depreciation fund at the end of third year comes out to be 81,008.4 rupees. So this is how depreciation fund and the book value are calculated. What is the book value at the end of third year? Directly it is available, 8991. So preparation of this table is very critical for any problems associated with depreciation. Now we will calculate this depreciation during sinking fund method. What is the formula used for sinking fund method? That is P minus SV into I divided by 1 plus I to the power of n minus 1. Substitute the values. When you substitute the values, you will get it as I value is 0.04 or 4% multiplied by 1 lakh minus 4,000 divided by 1 plus I to the power of n minus 1. N is 4 years. If we substitute, we get it as 22,607 rupees. Right? That is the depreciation per year. That is for the first year. Now what is the depreciation during second year? That we will calculate using the table. Prepare a table again. That's what I told you. Preparing the table like this will solve all the problems. You can answer any question asked if you have a ready-made table in front of you like this. So same procedure, book value at the beginning 1 lakh, depreciation amount during first year 22,607, book value at the end of that year 1 lakh minus 22,607, 77,393. So that is the value remaining in the asset at the beginning of second year. So what will be the depreciation amount during second year? 1.04% above the actual rate, that is 1.04 multiplied by uh, 22,607 rupees. So that will be 23,511 rupees. So that comes out to be 23,511, and the book value at the end of second year is book value at the beginning of second year, that is 77393 minus 23511, that is 53881.7. That will be transferred over here. That what is the depreciation during third year? 4% of the 4% above the depreciation amount of the second year. So what was the depreciation amount during the second year? 23511 multiplied by 1.04, you get 24451. 53881 minus 24451, you will get book value at the end of third year. Transfer that to book value at the beginning of fourth year. What will be the depreciation amount during fourth year? 4% above the depreciation of the third year. What was the depreciation of the third year? 24451. 4% above that. That is 25429. So when you calculate, you should get this as yes. This is the cross check. If everything is proper, then at the end of nth year you should have the salvage value. If it is not there, calculation is wrong somewhere. So book value at the end of third year is 29,430 rupees, that we can get directly. If they ask what is the total depreciation fund up to third year, add 22,607 plus 23,511 plus 24451. It is as simple as that. The third problem is a bulldozer is purchased for rupees 80,000, is its estimated life is 10 years and its scrap value is given as 20,000. Diminishing balance method is asked. The initial cost is given as 80,000, scrap value is 20,000, life is 10 years. Percentage depreciation in diminishing balance method is calculated using this formula. Apply the values, substitute the values, we get it as 12.94%. So what is the first year's depreciation? Apply the table. So depreciation found after 3 years, same procedure, 12.94% of 80,000, some amount you will get, substitute that from, subtract that from 80,000, you will get 69,648. That comes out to be book value at the beginning. 12.94% of that will be the depreciation amount during second year, subtract from 69,648, that is the book value at the end of second year. Bring that to book value at the beginning of third year, calculate 12.94% of that as the depreciation amount during third year, subtract it from the book value at the beginning of the third year, that comes out to be 52,789. When you have these calculations, calculating the depreciation fund after third year or whatever it is, everything is very easy. So depreciation amount at the end of third year is initial value minus book value at the end of third year, that is 27,210. You can add these three values, depreciation of first year plus second year plus third year, that will also give the same answer, or else you can subtract the book value at the end of third year from the initial value, that will also give you the total depreciation amount at the end of third year. Both are one and the same. Let us go to the next problem. A new generator costs rupees 4 lakh rupees. Life is given as 15 years. Scrap value is given as 1.5 lakhs. Interest rate is 5%. Use the sinking fund method. Formula is simple. Same formula. P minus SV into I by 1 plus I to the power of n minus 1 at 5%. Calculate. Substitute the values. We get it as 11,574 per year, or that is the value during the first year. So if the interest rate is 15%, what would be the depreciation amount? It would be 5259.4 per year in the sense it's for the first year. Okay, it's not per year exactly, it is for the first year. So next year it goes on increasing. So this is how the depreciation costs are calculated uh, using any of these methods: straight line method, or SOYD method, or declining balance method, or sinking fund method. So this is very simple calculation, simple arithmetic calculation. Only four formulae you need to remember. Apply those formulae, substitute the values, and you will get the answer. Again, there should not be any scope for mistake, because this is also a very simple chapter. So here I can see that as the rate of interest increases on the depreciation amount, the depreciation charge during the first year will be reduced, but later it goes on increasing. Thank you.